Have you ever felt like the financial world is just this vast, noisy ocean?
Oh, definitely.
Just a constant barrage, right?
Mm.
Crashing waves of hot tips, flashing charts, complex jargon.
Yeah, all seeming designed to make you feel like you're missing out.
Exactly. Missing some secret treasure map. But what if the compass you need to navigate all that isn't some secret gadget? What if it's just, well, common sense?
It's an appealing thought.
Welcome to the Deep Dive. This is the show where we try to cut through all that complexity and really pull out the essential nuggets of knowledge from, well, a stack of powerful sources. I'm your host, ready to explore these foundational truths.
And I'm here to help guide us through them.
So today, our mission is to really dig into the timeless wisdom of true investment legends, John C. Bogle and Benjamin Graham.
Two giants, for sure.
We're looking to understand those enduring principles, the things that protect your portfolio, foster long-term growth, all by aligning with, a common sense approach to the markets.
Sounds like a plan. Where should we start? Bogle.
Let's start with Bogle. John C. Bogle. Fortune magazine called him an investment giant of the 20th century. Time magazine, too.
And rightly so. Founder of Vanguard.
And the creator of the very first index mutual fund. It's actually hard to overstate how much he changed things.
Fundamentally transformed investing for everyday Americans. Yeah. Really put the individual investor first.
Even Warren Buffett said Bogle's work was cogent, honest, and hard-hitting, a must-read for every investor. High praise.
Extremely high praise. And then you have Benjamin Graham.
Right. The intellectual godfather, you could say, of value investing.
Author of those foundational texts, The Intelligent Investor, Security Analysis.
Classics.
Absolutely. And what's really remarkable about Graham, and our sources highlight this, is that his core principles, they're rooted in such profound common sense, and decades of experience on Wall Street, but they're at least as valid today, the sources say, as they were during his lifetime.
Yeah, it's pretty incredible. Timeless wisdom.
It really is. His insights just seem to transcend specific market conditions, cycles, all of that.
So it's clear then, this deep dive isn't about chasing the latest fad.
No hot stock tips here.
Definitely not. It's about getting at those foundational truths, protecting your portfolio, fostering growth, using common sense. But, those hot tips are tempting.
They always are.
So what makes this Bogle and Graham common sense approach so enduring? Why does it stick around when everything else screams get rich quick?
Well, I think it's because their principles tackle the really fundamental stuff, the unchanging aspects of the market, and maybe more importantly, human behavior.
The human element.
Exactly. They understood that the biggest threats to your long-term success as an investor, they often come from within. Meaning from fees, from taxes, and from our own emotions getting in the way. Bogle especially was just relentless about simplicity and low costs. He saw them as maybe the most important secrets to success.
Simplicity and low costs. Okay, it sounds almost too simple.
Right.
Why do these costs, these tiny fractions of a percent, why do they matter so much in the grand scheme of things?
It boils down to what Bogle famously called the tyranny of compounding.
The tyranny of compounding. Okay, unpack that.
Imagine trying to run a marathon, right? But you've got this tiny, almost invisible weight strapped to your ankle.
Okay.
At first, you barely notice it, but over 26 miles, that little weight just drains your energy, slows you down.
And makes a huge difference by the end.
Precisely. It ultimately determines if you finish strong or not. That's exactly what seemingly small fees and taxes do to your investments over decades. They compound into truly staggering differences in capital accumulation over time.
Staggering differences. Can we put numbers on that?
Yeah, let's try. So our sources show that the average actively managed equity fund, its stated expense ratio is around 1.5% a year.
Okay, 1.5%.
But the lowest cost funds, often index funds, they come in at maybe 0.2%.
Wow, that's a big gap already.
It is, and that's before you even consider the hidden costs.
Hidden costs, like what?
Things like portfolio transaction costs. The cost of all the buying and selling the fund manager does. That can easily add another 0.5% to 1.0%, maybe even more, each year.
Why so high?
Because of high turnover. The average turnover for these equity funds is, get this, 85%.
85%. So they're swapping out most of their stocks every single year.
Pretty much. So when you combine the stated expenses and these transaction costs, Bogle called this whole drain the fiscal drag.
Fiscal drag. Like an anchor.
Exactly, like an invisible brake constantly slowing you down. This drag can easily exceed 3% per year.
3%.
Think about that. If the market gives you a 10% return, that 3% drag consumes nearly a third of it before you even see it.
That's significant.
And it gets worse when you look at income. These costs can just slash the income your investments generate. So if your fund could have paid you, say, almost 2% in income, after costs, you might be left with less than 0.5%.
So 3/4 of the potential income just vanishes.
Vanishes. Gone. Before it even hits your pocket.
That's incredible. It really is a relentless drain. So if Bogle saw this so clearly, how did he propose we actually avoid this drag? How do we put the investor first?
Well, his solution was radical at the time, but actually elegantly simple.
Which was?
The index fund.
Ah, the famous index fund.
He saw them as the way to essentially bypass all these excessive costs and the underperformance they almost guarantee over time.
How do they bypass them?
Well, for one, they're inherently tax efficient because they have very low turnover. They mostly just buy and hold the stocks in the index.
Less buying and selling means fewer taxable events.
Exactly. And the results speak for themselves. Our sources show the original Vanguard index fund, after all the costs and taxes were factored in, it actually outpaced 97% of all actively managed funds.
97%. That's astounding.
And that efficiency really contributes to their superior long-term performance.
Okay, so lower costs, better tax efficiency.
What else? Well, beyond that, index funds generally have a lower risk profile, too.
Lower risk. How so?
Morningstar data confirms this. Index fund risk is actually more than 30% below actively managed funds on average.
30% lower risk.
Yeah, and if you look at their 10-year standard deviations, that's a measure of volatility. It's substantially lower. About 16% for index funds versus nearly 20% for the active ones.
So basically a smoother ride. Less up and down.
A significantly smoother ride, yeah. Their prices tend to fluctuate less dramatically, which means, less stomach-churning volatility for you as the investor.
That sounds appealing. Is this just Bogle's view, or?
Oh, no. Other investment luminaries totally agree. Peter Lynch, the legendary active stock picker.
From Magellan Fund fame, yeah.
He flat out stated, most investors would be better off in an index fund.
Wow. From him.
From him. Charles Schwab, founder of the brokerage firm, talks about the power of indexing. Even John Fossil, who used to chair Oppenheimer Funds and active manager, he conceded that the average fund can never outperform the market in total.
So the evidence seems pretty overwhelming.
It really is. Indexing captures market returns efficiently, and it does it with lower risk.
Okay, so Bogle gave us this really practical blueprint. What to buy, broad market index funds, and how to keep those costs way down. Essentially, don't fight the market, just own it cheaply.
That's a good summary, yeah.
But then, once we own those investments, how do we think about them?
Yeah.
Especially when, the market goes nuts.
Yes. The emotional side.
The news is full of panic, or maybe irrational exuberance on the other side. That's where Benjamin Graham comes in, right? His timeless wisdom becomes our guide here.
Absolutely. Graham's core principle really shifts how you see a stock.
How so?
He insisted it's not just a ticker symbol flashing on a screen, not just an electronic blip.
It's more than that.
It's an ownership interest in an actual business, like owning a tiny slice of, a coffee shop or a tech company.
Right, a real business making real things or providing real services.
Exactly. And just like that local coffee shop, its true underlying value comes from its earnings, its assets, its long-term prospects.
Not just what someone's willing to pay for its stock today.
Precisely, not just the daily price fluctuations. And that simple idea, which is often forgotten in the frenzy, is actually profoundly liberating for an investor.
Liberating how?
Because it helps you detach from the market's mood swings. This understanding is absolutely key to Graham's famous market as a pendulum analogy.
The pendulum. I've heard that one.
He described the market as constantly swinging between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap.
So swinging from greedy to fearful, basically.
He got it. And the intelligent investor, Graham says, is a realist, someone who understands this dynamic and, crucially, sells to optimists and buys from pessimists.
Buy low, sell high. Sounds simple.
It sounds simple, but Graham knew it's incredibly difficult to actually do because it means going against the crowd.
Right, acting counterintuitively.
It means acting against your own powerful instincts to join the frenzy when everyone's buying or panic when everyone's selling. It's about leveraging the market's irrationality, not getting swept up in it yourself.
And that ties into his other big idea, doesn't it? The margin of safety.
Directly. Yeah, the margin of safety is central to Graham's philosophy. It simply means buying a stock for substantially less than what you calculate its intrinsic value to be.
So buying it at a discount to its real worth.
Exactly. It's like buying a $100 item for $60 or $70. That difference, that's your margin of safety.
And what's the point of that margin?
It's your built-in protection. Protection against errors in your own judgment, because nobody's perfect at valuing a business, or protection against unforeseen bad news, like an unexpected recession or a problem with the company.
So it's like a financial shock absorber.
That's a perfect way to put it. It leaves plenty of room for error, gives you that cushion.
Now, what's fascinating reading the sources is Graham's view on complex forecasting. He seemed pretty skeptical.
Deeply skeptical. It's quite striking, actually. He explicitly stated that even after 44 years on Wall Street, decades of experience, he never saw dependable calculations that went beyond simple arithmetic or the most elementary algebra.
Wow. No complex algorithms needed.
He actively warned against them. He said, the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions.
So complexity doesn't equal accuracy in his view. It might even mean the opposite.
Precisely. It's a powerful counterpoint to the constant allure of fancy models that claim to predict the future market moves.
Seems impossible anyway.
Graham certainly thought so. He believed investing should be based on protection, not projection. Protection from overpaying for a stock, and maybe just as importantly, protection from overconfidence in your own judgment.
Humility, then.
Humility in managing risk you can control, like the price you pay, rather than trying to predict an inherently uncertain future. It's not about predicting tomorrow's headlines.
Okay, so Bogle points us towards low-cost, simple indexing. Graham points us toward understanding value, using market swings, and having that margin of safety. Both steer us away from flashy, short-term moves.
A clear, patient path.
But if it's also simple, so sensible, why do so many investors still struggle? What's the missing piece? What's the discipline needed to actually do this common sense stuff?
That's the million-dollar question, isn't it? Unfortunately, despite the clarity of this wisdom, many investors, especially mutual funds, show these consistently counterproductive investment patterns.
Counterproductive how?
Mostly characterized by a really short-term focus and rapid turnover. Our sources show the typical turnover rate for holding fund shares is 31% annually.
31% turnover. What does that mean in years?
It suggests the average holding period is only about 3 years.
3 years? That's not long-term investing at all.
Not even close. And it's a stark contrast to earlier periods like the 60s and 70s. Back then, turnover was only about 8%.
Which implies?
A holding period closer to 12.5 years. Much more patient.
So people are much jumpier now. Why is that bad?
Because this short-term thinking often leads investors to do the exact opposite of what Graham advised. They tend to buy high, usually after a period of good performance, and sell low, often in a panic after a downturn.
Chasing returns and getting burned.
Exactly. And this kind of short-term behavior runs smack into another powerful financial principle Bogle often highlighted: reversion to the mean.
Reversion to the mean. Okay, what's that?
It basically means that extreme performance, whether it's exceptionally good or remarkably bad, tends to eventually pull back towards the average over time.
Like a pendulum swinging too far one way.
And then inevitably returning towards the center.
Yep.
Things don't usually stay amazing or terrible forever.
Is there evidence for this?
Oh, yeah. Bogle's data provided what he called glaring proof. He looked at the top quartile general equity funds from the 1990s, the best performers.
Yep.
Of those 99 top funds, guess how many fell back towards or even below the S&P 500 index return in the next decade?
Maybe half.
72%.
72. Nearly 3/4.
Almost 3/4 just faded back to average or worse. There's a famous example, too. The Legg Mason Value Trust.
I've heard of that one. Bill Miller.
That's the one. It beat the S&P 500 for 15 years straight. An incredible run.
Unheard of, almost.
But then, later on, it fell behind the index by an astonishing 43 percentage points over a period.
Ouch. So the lesson is?
Superior past performance is simply not predictive of future success. Chasing those hot funds is often, frankly, a fool's errand because of reversion to the mean.
So it sounds like the shared advice, then, from both Bogle and Graham, really boils down to one critical rule to fight this tendency. Impulse is your enemy.
That captures it perfectly.
It's fascinating, isn't it? How much of successful investing isn't really about complex math or finance, but about human psychology?
It's hugely about psychology. Our brains seem hardwired for, immediate gratification, action bias.
Which clashes directly with the patience needed for long-term success.
Absolutely. Bogle actually laid out a few simple rules that really capture this essential discipline.
What were they?
He said, invest you must. The biggest risk is the long-term risk of not putting your money to work. So don't let fear keep you on the sidelines.
Okay, get in the game.
Then, time is your friend. Give yourself all the time you can. Let compounding do its thing.
Let the magic happen.
Compound interest is a miracle. Impulse is your enemy. Eliminate emotion from your investment program.
Eliminate emotion. Easier said than done.
True, but that's the goal. And he concludes with this really powerful assertion. The secret of investing is, finally, that there is no secret.
No secret after all that.
No secret formula, no magic bullet. And he loved quoting Thomas Paine here. The more simple anything is, the less liable it is to be disordered. Keep it simple.
Wow. What a powerful distillation of wisdom. Listening to all this, it really does boil down to something so deceptively simple.
Deceptively is the right word.
Makes you wonder why it isn't just the default approach for everyone. So maybe let's quickly recap our deep dive into Bogle and Graham. It seems to give us 3 core takeaways for common sense investing. Ways to cut through that noise.
Sounds good.
First, it has to be the crucial impact of low costs.
Absolutely. And the immense power of indexing that Bogle championed for achieving that long-term wealth building. It's really about letting that magic of compounding work for you, not against you.
Right. Minimize that silent drain from fees and taxes.
Exactly.
Okay, second takeaway.
I'd say it's the fundamental importance of viewing stocks the Graham way. Not as ticker symbols, but as ownership in actual businesses with intrinsic value.
Understanding the business behind the stock.
And understanding the market as that emotional pendulum, using its irrational swings with a robust margin of safety.
So leveraging the irrationality, not being part of it. Selling to optimists, buying from pessimists.
You got it. Rather than being swept up in the crowd's hysteria.
And the third point.
It has to be the essential discipline of long-term investing itself.
Patience.
Patience. Actively avoiding that speculative short-termism we talked about. Understanding reversion to the mean. Don't chase past winners. And trusting that time really is your friend.
Let financial physics work for you, not fleeting emotions or hype.
Precisely. It's not about complex formulas, really. It's about these timeless, common-sense principles. Principles that have stood the test of time, even if common sense isn't always common practice.
That's a great way to put it. We've covered a lot today, really digging into cutting through the noise and embracing common sense in your investing. As you listening, reflect on these powerful, yet really simple principles from Bogle and Graham. What stands out to you from today's deep dive?
Good question to ponder.
How might adopting a more common-sense approach maybe reshape your own financial future, allow you to navigate that noisy financial ocean with, hopefully, greater clarity and confidence?
Food for thought.
Indeed. Thank you for joining us on the Deep Dive. We really hope this conversation helps you understand what truly matters most in your investing journey.
I hope it was helpful.
Until next time, keep learning, keep growing, and try to keep that common sense firmly in hand.